So when people look at the housing market and it's all doom and gloom, hey, we've got a rough patch, but we're still going to have tight inventory. And then as incomes start to catch up with it and affordability starts to catch up, I believe we're going to see a bit of a resurgence.
The housing market in the United States is under incredible pressure and is changing at a remarkable rate. We have mortgage rates that are double what they were only 2 years ago. And yet prices are near all-time highs and are staying there. They are remaining stubbornly high when you'd think they would be coming down. There's no one that I know who has a better base level knowledge of the housing and mortgage space than Barry Habib, and he is going to be our guest on this week's Global Macro Update. Barry Habib is the CEO of MBS Highway, and his predictions have been incredible. I am looking forward to giving you an update on where Barry sees mortgage rates headed in the near term and longer term, what he sees for housing prices, and how the limited supply of housing stock is going to impact the U.S. housing market for years to come. I hope you enjoy this conversation with Barry Habib. Barry Habib, longtime friend of ours at Malden Economics. It's always good to be with you, my friend. Thank you for joining me.
Ed, it's such a pleasure. I'm a big fan of all the great work that you do. I look forward to your interviews, and you always do such a great job, so it's such a privilege to be with you.
Oh, thanks. I appreciate the support. And, before we get into the interview too deep, I have to give you some props, Barry. As part of my prep a few days ago, I went back and I rewatched your session from our strategic investment conference. That was back in May of this year. And I got to say, every prediction that you made has held up from that. You were right when you said that most economists heading into that conference were saying inflation had already peaked. And you said, absolutely not. It's going to go higher. And you were right. You said that the mortgage industry was going to be rough in terms of rates for the entire summer. And you thought that we wouldn't see any kind of relief or a peak in inflation until right about now, sometime in October. So we're there. How do you feel about inflation right now?
Well, first of all, thanks for the kind words. And, the old saying, what have you done for me lately? So we'll see if we can try and get these a good look ahead, because that's important. That's what everybody wants to know. We don't think that that it's going to get too much worse here on the interest rate front. Now, listen, admittedly, I'll be the first to admit that while we got the direction and what appears to be the timing pretty good, missed it on the extent of the move up in rates, because we didn't see some of the things that were happening with stimulus and what was going on with Russia and Ukraine. So we didn't get the extent of the move up in rate.
To your credit, though, Barry, to your credit, nobody got that right.
Well, thank you. But we do think that there's reason, if you're rooting for bond prices to improve and interest rates to come down, to see some glimmers of hope here. We think that inflation peaks in the very near future. And there's a reason for that. And if you'd like, I can actually show a chart, because it's easier to see it. What the Fed looks at for their methodology is the PC, the personal consumption expenditures report. And they look at the core rate. And a lot of people scoff at that. They say, well, why do you look at the core? Well, core strips out food and energy. And people say, I need food and energy. Don't. Of course, we know that. But the Fed wants to focus on what they believe they can influence. They can't influence, pipeline disruptions for energy prices or weather conditions causing food prices. But what they can influence, they believe, is the core rate. And on the PCE, that core rate is currently at 4.9%. Now, that's way too high. But people get confused because they hear inflation in the eights and they see the Fed's target at 2, and they say, well, that's just too far apart. While it is far apart, is a difference between 4.9% and 2 than it is 8% and 2. So yes, the Fed has some heavy lifting to do. Now, the report that, as people are watching this, that just came out is something that I think is a better measure of inflation, although the Fed prefers the PCE, and that's the Consumer Price Index, or CPI. It has a greater weighting on things like putting a roof over your head, which we need, or out-of-pocket medical expenses. So it's a more realistic approach to looking at where inflation is. In this report, that core CPI number is right now year over year at 6.3%. But this chart that we'll share right now, I believe, will help us to see and interpret where we can expect things to go in the very near term. So as we look right now at this report, and I'm going to just quickly go right to it here. We can take a quick peek and we can see that the report of 6.3% year over year, which is what we're running, is truly made up of 12 individual months or 12 individual monthly components. So the reason why the bond market had an awful go in September is because the second week of September, we got that August number, and the August number was up 0.6%. It replaced August of 2021 because you only have 12 months. So as the new data comes in, it replaces now the 13-month-old data. So this change of up 0.2% being replaced by up 0.6, that made the market just puke as we went on a year-over-year basis from 5.9% year-over-year inflation on the core CPI to 6.3%. And of course, inflation, because it erodes the buying power that you receive on your fixed payment as the recipient of that bond, it erodes it more rapidly. So the only way to get compensated for that is to charge a higher rate so you can offset the more rapid rate of erosion due to higher inflation. Well, as people are listening to this, we will have now received the report for September of 2022, which will replace September 2023. Now we've got this rounded at 0.3%, but you can see here's the 0.3 of the line. It's really like 0.26. So the reason why that this was expected to be a turbulent time and we didn't think inflation would peak was because as the new numbers came out, they would be replacing numbers that were set at a low bar. So easy to exceed these numbers and potentially easy to see this number go up. Now, I don't know what this number is going to be released is going to be, but the chances of it being greater than 0.26 for the month of September of 2022 are probably greater than them being a lower number. So that's why we see a little bit of heartburn in this particular time frame. However, here's the good news. Starting with the October 22 report, which we'll be receiving November 10th, that is going to begin a string of reports that will be replacing much higher numbers here, as you could see. As we go into the fourth quarter of 2022, we will be replacing fourth quarter of 2021. And even in the first half of 2023, as we replace these 2022 numbers, which are higher readings, we have a really good chance to see inflation decline and decline by a significant amount. And as that happens, long-term rates, like mortgage rates, will then probably follow suit, just like they always have. I mean, you can see here, this is just a cute thing about, our Fed chair not understanding inflation, but we can see here the bottom line being the rate of inflation and this upper line being mortgage rates. Now, whether it be mortgage rates or any kind of long-term bond, that's going to be driven by inflation. So when we see inflation go up, mortgage rates go up. Inflation comes down, mortgage rates come down, and so on. It didn't follow that pattern. It was broken with quantitative easing. Once the Fed fixed the game and rigged the game, they were buying enough mortgage-backed securities and treasuries to keep yields very low. And as you can see here, the Fed did a good job, whether you want to call it a good thing or not, but they did a good job of keeping mortgage rates roughly at 3% for the QE period. But meanwhile, inflation was moving up at a pretty significant pace. Normally, mortgage rates would have gone up, but the Fed rigged the system. Notice once they took the guardrails off and let the market behave freely, mortgage rates did what they always do, move with inflation. So as inflation went up, mortgage rates went up. Inflation dipped, mortgage rates dipped. Inflation up, mortgage rates up, and so on. So as you can see, we are in a situation where as inflation goes, so will mortgage rates go. Now, there are other factors, of course, but the main driver will be inflation. And we believe that there's reason to feel pretty darn good that because of the Fed rate hikes, maybe slowing things down too much, whatever, okay? But also, we are hearing reports that the economy is showing some signs of slowing down. We know that people are having other alternatives to put money to save it instead of spend it. I mean, look at your 6-month
Right.
treasury at 4%, probably go to 4.5 with the next Fed rate hike, or certainly on December 14th with the subsequent Fed rate hike. You may be somewhere close to 5%. That's going to be tempting. And remember, no state income tax on those. So that's going to be a tempting risk-free return, essentially. So people, instead of spending it, will save. And then it's much more expensive, of course, on those variable products like the consumer industrial loans, car loans, home equities, credit cards. So that slowdown will occur. And then we should see inflation overall come down.
So your thesis or your point, which is proven. So it's not a thesis. You've proven that mortgage rates follow the rate of inflation. But you pointed out one big variable that has been with us for the past decade, and that's the Federal Reserve buying massive amounts of mortgage-backed securities, trillions and trillions of dollars over the last decade. That's now stopping, and the Fed is, in fact, letting their MBS holdings burn off, expire. What kind of impact will that have on rates?
So first of all, it's a great question, and I love the way that you put it, because some people do get confused and they think that the Fed is actually selling. They are not selling, and they have made it clear that they have no intention to sell. So that's a big difference there. So what they're doing is now they're no longer purchasing mortgage-backed securities. And they were purchasing a lot of them, Ed. They were outright buying $40 billion a month, but then what they were doing is not allowing this runoff. And the mortgage market was bringing so much that there was, because of refinances and payoffs and principal payments, they were purchasing an additional $70 billion. So they were buying $110 billion a month of mortgage-backed securities, and that rigged the game and kept rates low. So now the change has been they're going to allow running off. They're not going to be reinvesting principal payments, payoffs from refinances, and purchases. But purchases have slowed, and I know we'll talk about the housing market. Refinances have slowed by 86%, and principal payments are still there. So people are still making principal payments. So what the Fed is now doing is not buying those. But the good news is, because they've trickled to what they were, the amount of mortgages coming to the market is down by about $2 trillion. The Fed is not repurchasing. What they said is they'll allow $35 billion a month to run off, or somewhere in the neighborhood of $420 billion a year. So it's $420 a year that they're allowing to run off, but there's $2 trillion less coming to the market anyway. So from a mortgage perspective, it should not be very turbulent. It shouldn't cause that much of a disruption. Conversely, on the Treasury side, the big paradox here is you actually have much more Treasuries coming to the marketplace, which they're not now purchasing. And the Treasuries coming to market are greater because we've had so much more debt that now has to be financed. So I think you'll see a greater disconnect between yields on government securities and mortgage-backed securities.
So in terms of rates, are you willing to put a prediction out there of where you think a 30-year will be, say, 6 months from now?
I think there's a very high probability, given where the market appears to be heading. Now, look, there are things that we don't know, right? So those black swan events that could always come up. An example is unfortunate circumstance, Russia invasion of Ukraine, which did certainly throw things out of balance. We have some turbulence going on now with the Bank of England, and we know short term what they're doing, but we don't know what the long term implications as they try to stabilize that marketplace. And of course, what's happening with currencies is now also inflicting a lot of pain. As we see our gasoline prices going up because of the currency carry, it is having a much more damaging effect abroad. So there are many things to consider. But given that, we think there's a high probability that mortgage rates come back below 5% within the next 6 months. Maybe an outside chance by the end of this year. But because of those inflation readings, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5, below 5 within the next 6 months. And Ed, that changes so many things
That's a
First,
huge
speaking about
change.
the housing market, if I've got a 3% rate right now, I want that house. I really like it. But boy, going from 3% to 6.25, maybe I'll stay where I am. But, 3% to 4.75, I really want that house. My family needs that. Maybe I'll go do it. So I think it changes a lot, especially for first time home buyers too, which now can get a rate that's easier to obtain, that purchase of a home. Also refinances. More than half the mortgages in right now in existence are above 4%. So you should start to see refinance activity begin to perk up, especially on cash out refinances. So I think there's good news on the horizon. We just got to go through a rough patch here to get there.
So before we jump into what's happening in the housing market and housing prices, there's one last question on rates. If you're a first time buyer and you have to buy a house today, say you're getting transferred, you're going to a new city, you need to buy a house. What do you do for a mortgage? What would your counsel be? 3-1 ARM. If you think rates are going to go down, do you get a 30-year, a 15-year, a 3-1, a 5-1? What do you do?
So there's two things in the mortgage market today that are causing a disruption in the way we would normally think. A short term in the property, you would get what's called a hybrid ARM, where you're fixed for the first 3, 5, 7, 10 years, and then it'll adjust. But by then you might have moved, but because the yield curve is now inverted, as you well know, there really isn't much margin to benefit from those shorter period adjustable rate mortgages or hybrid ARMs. So there's really no juice in it to benefit. The other aspect that you would normally say is, well, okay, if I've got to take a fix, that's fine. Maybe I'll take a 30-year fixed rate and pay 0 points. Try and limit the closing cost because I'm not going to be in that home that long. Here's the problem, is that the secondary market, think about it from an investor's standpoint. If you're going to invest in a mortgage, if the customer's paying 0, you have to sell that in the secondary market at a premium because how's everybody going to get paid? How's the lender going to get paid? The mortgage originator? So a $500,000 mortgage has to be sold at, let's just say, $510,000 or a 2% premium at 102. So that would be the pricing, 102% or 102. But if you're somebody laying out that extra $10,000, it's a great deal for you because you're getting additional yield. You get maybe a little bit more on the yield. You might get another 0.5 or 0.75% in yield. But that means it's going to take you a couple of years to break even on the 2% upfront you laid out. If you think that mortgage is going to last for 7 or 8 years and not pay off or refinance, I love that move. But now the smart money is thinking, hold on a second. Perhaps some people see it the way we do. They see slow down the economy, inflation coming down, mortgage rates probably start to come down. And that means any loan that's going to get done today at that higher yield is probably going to refinance within the next 12 months. So I might have thought I'm getting a higher yield, but if I laid out, 102%, I'm only going to get 100% back when it pays off. So that extra 0.75% yield, it's going to take a little over 2 years. That means I'll lose money. So what they're doing is they're making it painful, meaning they want much higher yield for that 0-point loan. So it's like, oh my gosh, I got to pay 7.25 or make it unavailable at all. So to answer your question in a long way, Ed, I'm sorry to do it like that, but it needs some background on it.
Yeah.
For anybody purchasing a home. The bad news is it's hard to get ARMs, adjustable rate mortgages, and it's also harder to get a 0-point quote. The good news, and I mean this, it's good news, is that you can now negotiate. You can now buy a home, and instead of having to pay over asking price by a significant amount, and then I can't even get an inspection. Heck, I might not even be able to get an appraisal. It's more of a normal feel. I can negotiate a little bit with the seller. I can get some terms. I can close when I want to close. And I really do believe, Ed, that while this is going to be, as we talk about the housing market, this will be a great investment for that individual. And then we have to also compare to renting. When we compare to renting, rents are no picnic. They're going up 12, 13% a year. There's no equity buildup. People forget about the principal portion. That's your own money that's being built in the home. So if you're going to be in that home for probably less than 2 years, rent. But if you're going to be in the home longer than 2 years, buying a home clearly makes sense, especially the longer you intend to be there.
But maybe maybe wait? I mean, so I have lots of nieces and nephews that are in this exact situation, Barry, where they've been wanting to buy a house for 2 or 3 years now. They've been outbid by cash buyers, all cash buyers, every single time. And they're so frustrated. And now when rates went up, they thought, well, at least maybe we can get a chance to buy a home for a little bit less money. But prices don't seem to be moving as much as you would think. So that's my next question for you is where do you see housing prices going and why haven't we seen a rollover in prices like you would expect?
So there's a lot of reasons for that, Ed. And when we think about the housing market, there's a few differences. A lot of analysts have a harder time adjusting to when they look at stocks versus when they look at housing. Because I could sell a stock and walk away. But if I sell a home, where do I live? Unless it's an investment property, right? So someone needs to live there. So like any other price discovery, it's supply and demand. Now, the demand is driven by household formations. In the United States right now, we're forming approximately 1.7 million households per year. What's a household formation? There's a family living in a dwelling, a unit, right, a home, and someone comes of age and they say, okay, I'm going to move out and get my own place. It's the same family, but now occupying 2 residences instead of 1. That's a household formation. So we're getting about 1.7 million of those per year. So how is that demand met? It's met with supply. Supply, it's a little different. It's not somebody just selling a home because now they got to buy a home. So they're inventory neutral. It's new construction. It's builders not just starting homes, but completing homes. You know, there's a lot of misleading data. You'll get new home sales will come out, or housing starts, will come out, and the media will say, wow, it's a 9-month supply. So they take the amount of homes for sale divided by the pace of sales. Oh, it's 9 months, that's high. A lot of that is dirt. You can't move into it. If you looked at completed inventory, it's 0.86 month supply. So it's still very tight even on the new construction side. Sure. And when we take a look at the overall new construction of what's completed, there's about 1.3 million homes that are being completed, but yet about 100,000 of them, homes get retired. They either get rebuilt, remodeled, redone, aging, they get torn down. So we're only netting somewhere around 1.2 million homes coming to the market, whereas we need about 1.7 million homes. So how is this squaring? It's squaring with prices not coming down as much, even though demand is softer. It's squaring with you have people waiting and staying at home a little bit longer now. You have it where you get some negotiation, but not too much on price. So homes are still selling within 2 weeks. According to the National Association of Realtors, actually it's 16 days now. So it's still very, very fast that homes are selling.
Now that supply chains seem to have eased up a bit, Barry, does that spell some hope for housing starts, particularly the maybe more affordable or first home buyer end of the supply?
So on that affordable side, it's harder because there's less margin with the lower prices, right? That's been the problem all along, is that builders weren't building those homes because they were going after the bigger ticket, higher margins. And real estate, like anything else, is very local. If you're in Los Angeles, San Diego, San Francisco, Denver, Phoenix, those markets may come in a little bit, maybe 4, 5, 6%. We might see declines, but they have had an enormous run. For the rest of the country, we do see modest, very modest, low single-digit appreciation. Now, some may be down a little bit, some might be up a little bit, but there is just not enough inventory. The supply chain easing certainly adds hope that builders can now have an easier time of delivering some of those homes that are in process, and labor is coming back. But there is another benefit to the supply chains, and that is from the inflation front. More goods, more inventory, prices coming down a little bit. So we could see that helping us as well to bring mortgage rates down. And the other thing that people don't look at is a lot of folks look at affordability, right? And they say, well, home values have gone up 18% in the past year. So that makes it more expensive. Interest rates have gone up over 3% in the past year. And goodness gracious, that means the payment is going to be maybe $1,100 or $1,200 a month more on what used to be a $400,000 mortgage today We'll increase that by 18% to account for the inflation in the price of the home, the appreciation. So now 18% is 472. Let's take that a little above 6% versus around 3%. And now you've got $1,100 or $1,200 a month more. But the media stops there when they kind of present that. And what they don't consider is income. To have qualified for that home, according to statistics from Fannie and Freddie, not just to get the bare minimum qualification, but the average person that purchased it had a household income of $9,000 a month. ADP, which gives us a lot of good data, they measured 25 million records. If you stayed on your job, your income had gone up by 7.8% year over year. If you switched jobs, it went up by 15.7%. So based upon these numbers, if you took, most people stayed. So if you took 9%, well, you've mitigated a lot of that increase. Now, of course, gasoline's gone up, food's gone up, service, we get that, okay? But you've mitigated a lot. But then let's not do what the Fed does and have a hard time seeing, further than their hand in front of their face. Let's look at next year. If you've got that payment fixed because you now have taken out that mortgage and you've secured that rate, only one thing can happen. Your payment can go down because if rates come down, you refinance it. So that's a benefit. But let's say that you don't do that, okay, for whatever reason. But your income, if it continues to go up at where job stayers are, according to ADP, at that 7.8%, you know that now you've not only mitigated the entire increase, but now you have a surplus in 2023. So when people look at the housing market and it's all doom and gloom, hey, we've got a rough patch. But we're still going to have tight inventory. And then as incomes start to catch up with it and affordability starts to catch up, I believe we're going to see a bit of a resurgence. And that's why, as John Templeton said, you want to be a buyer on the most pessimistic day. It's a lot of pessimism. This could lead to a good buying opportunity right now.
Interesting. Okay, Barry, last sector that I could speak with you all day about this. I just think it's fascinating, and your knowledge base is just unrivaled here, so I really appreciate it. But we've covered rates, we've covered rentals, we've covered the housing market. Let's talk a little bit about the multifamily sector, both from a developer and an investor perspective. How are you feeling? What are you seeing in multifamily housing today?
So while rental demand has decreased a bit because rents are pretty pricey, it's still very strong. Currently, vacancies are at just 4.1% per year. While it is not the all-time low, it is still very, very low. You do have a lot of benefit in having those multifamilies, bringing those rentals in. We have a tool within our site that shows investors how they can fare over the years. So on a cash flow basis, initially, probably be in a position where it might be flat to a little bit negative for the first couple of years. But then cash on cash starts to pick up. But where you really start to benefit is amortization. And very few people consider amortization. It is such a powerful benefit that you receive because while you might be laying out the cash, a lot of it is a forced savings. So, some of that cash is just going into equity and people don't always consider that. But appreciation, even at modest rates, Albert Einstein said that the eighth wonder of the world is compound interest. Well, appreciation is similar. If you were to take a look, now our forecast over the next, let's just say 9 years, because that seems to be about average if you have an investment property and you're going to hold it for a period, is 5.11%. That's our forecast. Of course, we could be off, we could be wrong. Nobody says we're dead on, but historically, it's been at 4.49. Let's call it 4.5%. Inventory situation is a little bit more tight. Formations are stronger. So we think there's going to be a little bit more tension for a slight move up in rates of appreciation because of that. But even if you looked at 4.5%, on a $400,000 home, it's hard to imagine. But over those 9 years, that 4.5%, that's $195,000 that it comes out to. If we're right at 5.11, it's $280,000, just that small increase. So there's huge amounts of money to be made. And when you put it on the whole outline and spreadsheet like we do, that means most people investing in those types of rental environments would get a rate of return, gross rate of return of about 320 to 330% over the 9 years. This is called the reverse geometric mean calculation to get the compounded rate. It's 17.6% per year over 9 years. And as you know, the greatest money managers in the world, if you got above 15%, you're like in the Hall of Fame. which is
Absolutely.
why people make so much money. Just one quick point I just want to make because it's interesting. So Kiplinger's recently did a story. And we're all kind of interested in this, right? What if you wanted to be in the top 1% net worth? The top 1%, the really, really top, right? You need a net worth of $10.8 million. So all your assets minus your liabilities. That's a pretty big number, right? Okay, so what about the top 2%? Well, it drops quite a bit, Ed. It's $2.5 million. The top 5%? Interesting. It's only $1 million. The top 10%, it's 800,000. And the top 50%, it's 500,000. Why do I bring this up? Because the same study showed that 2/3 of that net worth came from real estate. So
Yeah.
over the
Not
long
surprised.
term, you have to be in this game.
Yeah, it's one of the most under allocated asset classes among the average investor, would be my argument. Barry Habib, CEO of MBS Highway, always fascinating speaking with you. I will see you in May at the Strategic Investment Conference. Thanks again for your time.
Hope to see you before that, my friend.
Sounds good, Barry. I hope you enjoyed this interview with Barry Habib, CEO of MBS Highway. Barry's predictions are pretty unrivaled in this space. He won an award from Zillow and Pulsenomics in 2017, 19, and 20 for having the most accurate real estate forecasts out of a group of over 150 economists based in the U.S. So I found Barry to be incredibly accurate, and I really appreciate his time today, and I appreciate your time. Thank you for your support. If you felt like this gave you some value, I hope you take a minute to like this video and subscribe to our YouTube channel. Thanks again for watching. I'm Ed D'Agostino from Malden Economics. See you next week.